Hey, welcome back to Everyday Economics, the podcast that you learn about the economic world happening around you every day. I'm your host, Chris Krug. I'm the CEO of the 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics is a production of America's Talking Network, and you can subscribe to all of our podcasts at americastalking.com. To support Everyday Economics, please make a tax-deductible charitable contribution by clicking the link in the show description. We're recording this episode on Wednesday, August 28th. Wishing everybody a happy Labor Day in advance. Joining me as always, Dr. Orphe Divounguy. He's a PhD economist, smart guy, pretty well put together in terms of his wardrobe too.
Right back at you, man.
It's a pretty fancy shirt.
Right back at you.
I look like I'm dressed for the rodeo today. One of the things that I think is like one of the lingering debates among the social media pundits has to do with the real estate market. And I'd say also, we're not going to talk about the car market, but, they're largely saying the same things. Interest rates are going to get better and inventories are going to get better. So wait. You don't think that that's a good idea in the housing market? I've been waiting on the car market. I can't tell you how long, because it's like, it's supposedly going to get better. It's supposedly going to get better. It hasn't gotten better. I mean, not to a degree that I would like it to get better.
Yeah,
housing market.
Car prices are falling, man. Car prices are falling, so
they are. Yeah, they are. They are.
House prices are not falling yet.
House prices are not
in most markets.
Car
not
prices
in most
needed
markets.
to fall.
That's right.
Car prices needed to fall. The $1,000 monthly payment of this current era is, frankly, it's obscene, and it is one of those drivers that's really hurting people in their personal economics. You carry around a car note, that's $12,000 a year of your post-tax income. That's brutal. On the housing market, to get on to the point here, there's been some equilibrium in the housing market in terms of pricing. I mean, I get an update from my local friendly neighborhood realtor person, and it's gone from seller's market to kind of like 50-50 for whatever that's worth, right? That's their local measure here where I live. Okay. The interest rate as it is today, and this is straight from Freddie Mac, 30-year fixed rate, 6.46% on again, 30-year fixed. We're talking about the Fed making a change in all likelihood. You and I are speculating that it's going to be a quarter point. That would have a positive influence over the interest rate that people would be able to get. But I mean, the idea of waiting, what's your take on that?
So that is, I think that's the biggest misconception, that the Fed rate cuts are going to bring down mortgage raits somehow.
Well, it'll impact it somewhat. I mean, I think it'll impact it somewhat.
And I'll tell you why. This is why I'm so glad we're doing this episode. First of all, mortgage rates today already reflect Fed expectations. Okay. Right? Markets are forward looking. And so
yes,
traders expect 3 rate cuts right? And they expect 3 rate cuts. They expect the Fed funds rate to fall into the 3.25-3.5 range in 2025. And that's baked in to the mortgage rates we're seeing today. And unless you get a big shock, something that changes that shifts those expectations, you're not going to get a change in mortgage rates, even if the Fed cuts tomorrow, because that would be in line with expectations. And so I think that's an important point to make to our listeners. So I when I hear people say, I'm just waiting for the Fed to cut, I say, well, you look, the Fed will cut and you'll see it won't change anything. Now,
well, let's talk about
on the other hand.
So you're saying, hang on. So you're saying that the rate that people are seeing now, it's somewhat already pricing in what the Fed will likely do, right? Let's say the Fed does make those 3 cuts.
Absolutely. And so suppose the Fed makes those 3 cuts, right? It's very much in line with expectations, right? And so you're not going to see any big change in pricing. If, on the other hand, the Fed cuts by more than expected, right, because of some big deterioration in the labor market, because economic growth is slowing more than expected, then you're going to see a rush, a flight to safety, the safety of treasury yield, treasury bonds. Yields are going to drop. Mortgage rates are going to drop. And then, of course, you're going to get that big drop in mortgage rates that people want to see. But I would say be careful what you wish for, because in my life, there's only been a few times where we've seen massive drops in mortgage rates. Bursting of the dot-com bubble, you know what happened to the unemployment rate and your stock market, your earnings.
1999.
The global financial crisis and the start of a global pandemic. And so, no, I don't actually want
then 2020.
the labor market to crack in order to see mortgage rates. In fact, home buying demand slumps in recessions because people without jobs can't get a mortgage in the first place. And so that's not what we want to see, guys. That's not what we'd like to see is a strong U.S. economy, mortgage rates continuing to ease at a decent pace towards the Fed's 2% target, and a strong U.S. economy. And if that happens, right, then I don't think mortgage rates are going to decline very much from here. I think they might be kind of settling in this range here, right? The 6 to 6.5% range might be the norm, unless, of course, the labor market cracks. Now, of course, if you get more pressure coming from the federal government spending, and you get higher borrowing and bigger fiscal deficits, the pressure on rates is up, not down. And of course, to me, that's why I say to people, look, if you're ready to buy right now and you can afford to do it, now might be the best time ever. Because the risk of waiting is kind of high, right? Either because rates could come back up due to higher and higher fiscal deficits, or we get a big crash that brings rates down, along with a higher unemployment rate, a higher jobless rate. Anyway, that's my assessment of the whole thing, and I think people need to hear that. There's big misconception out there that people think, hey, we're going to get 3 rate cuts in 2024, and so mortgage rates are going to fall. No, that's all baked in. You know, markets have been expecting 3 rate cuts for a while now.
Well, I appreciate your thoughts as always. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other high-quality podcasts at americastalking.com.